cash flow and budgeting. Before we start with this, while doing financial planning, always give a thought as to where we are going and where we want to be. Before taking even a single step forward financially, one should define where they are currently at and at the same time should compare that current reality to a well stated and specifically defined set of personal financial goals and objectives. These personal goals and objectives should detail outcomes which are important enough to motivate our daily focus and action. A well-written statement will be the most useful thing to start in the process of defining specifically about things to be accomplished. To understand this, you should know the difference between cash flow and a budget. A cash flow statement simply determines how much income you are left with after meeting all your fixed and variable expenses. This statement is based on a simple calculation, that is, total income minus total expenses, which is your net cash flow. Such a simple analysis can be done annually, quarterly or monthly and is usually a monthly exercise as far as personal finances are concerned. It is as simple as doing on a napkin at a lunch and thus acts as the starting point in defining your personal financial reality. What are the essential things to be understood for this? Knowing the specific net cash flow number. Knowing whether it is a positive, negative or neutral, that is zero or break-even figure, is a critical step in achieving financial success. Still, knowing whether you are in the black or the red does not exactly define where your money is being spent, does it? But the statement of financial position indicates what a client owns at a given point of time. The cash flow statement reveals the client's cash receipts and disbursements over a specific period of time, which is usually 1 year. Also, it summarizes the inflows and outflows of cash and reveals the client's pattern of spending, saving and investing. Cash flow statement is a planning tool, one that projects the anticipated inflows and outflows for a future period. It can be prepared on a monthly, quarterly or yearly basis as already mentioned. Its projections are based on the established patterns of inflows and outflows. Client's goal for the designated period and on the effects of either implementing or not implementing the recommended financial plan. What are inflows? Inflows include gross salaries and wages, interest and dividend income, rental income, tax refunds and other money received by the client. If funds are withdrawn from savings or if invested assets are liquidated, the planner should list such inflows under a special inflow category of savings and investments to identify clearly the source of cash. These being a record of cash flows, amounts like dividend which are to be invested would be recorded as an inflow when received and as an outflow when reinvested in savings and other investments. Let's look at an example. If you are receiving rental income or surrender value of insurance policies that will be considered as your inflows for that particular month or that particular quarter, and if you are reinvesting such income either to buy an insurance policy or a mutual fund, it becomes your outflow since you are reinvesting the same. Now, let us understand what outflows are. Outflows are divided into three categories, namely savings and investments, fixed outflows, and variable outflows. Fixed outflows are relatively predictable and recurring expenses on which the client does not have much control. Typical fixed outflows are household expenses, mortgage payments like EMIs and insurance premiums. During our earlier discussion on data collections, we had touched upon the topic of household expenses like expenses on grocery, milk, mobile phone, travel, petrol expenses, etc. These are our normal household expenses. These can be termed as fixed expenses. Even the children's school fees or tuition fees can either be considered as a recurring expense or a fixed expense depending upon the period of their studies. Variable outflows are those on which a client can exercise some degree of control. These include expenses like expenditures for lifestyle, clothes, and entertainment. These are variables on which you can have control and plan your inflows and outflows accordingly. Net inflow. The net inflow is determined by subtracting the total outflows from total inflows, which in turn is your total cash flow, or otherwise called the net cash flow. Conceptually, this is similar to the net worth and deals with the flow of money during a specified time period. There is a difference between the terms net worth and cash flow. Cash flow only talks about money inflow and outflow, and your net worth is nothing but your total assets minus total liabilities. Since the cash flow statement reports only the actual inflows and outflows of cash over a period of time, the net inflow or net outflow for the period can be a positive amount, a negative amount, or even zero. Do not assume that a net inflow represents funds that are available for savings or investments, or that it should be used in achieving the financial goals. Typically, a net inflow exists due to differences in the timing of inflows and outflows. Precisely, if you want to understand the literal meaning of cash flow, it is nothing but the surplus left out of your total income after deducting all your expenses. The net amount you receive, which is otherwise your net cash flow, is your surplus and is available to park aside in achieving your goals. What do you mean by positive cash flow? Positive cash flow is the idle money which allows you to save, invest, or even permits you to go for purchases deferred by you in the past. On the contrary, negative cash flow is generally an indication to show that you are living beyond your means and would end up in incurring a debt unless you have a benefit to bridge an existing gap. A neutral cash flow or a zero cash flow is very unlikely, because a vast majority of people do not spend exactly till the last penny earned by them, thus ending up with a zero, which is a pure break-even point. Here, the calculation of real cash flow would be a real anomaly. Once the cash flow is known as positive or negative, the process of defining or developing a budget begins. The financial planner often gets a valuable intuition on the client's spending habits from the cash flow statement. Through this, the planner comes to know whether the client spends more than he or she makes, or is there a real net flow which paves the way for additional savings or investments. Also, in some instances, planners will come to know that if a family spends more than their income, in which case we would encounter a net outflow or deficit. Let us take a small example. Other income is rupees 5 lakhs, rental income is rupees 1 lakh, dividend interest received is rupees 20,000. The total inflow is rupees 6,20,000. Now, let us check the outflows. Total outflow comes to rupees 5,20,000, which is the total of fixed and variable expenses. Savings is equal to total inflow minus total outflow, which is rupees 6,20,000 minus rupees 5,20,000, which is rupees 1 lakh. This amount of rupees 1 lakh is the net cash flow in hand which the client can save. Here, based on the available data worked out with the client, you can consider making short-term cash flow planning. Cash budgeting means preparing monthly household budgeting and long-term cash flow planning. An individual's income and expenditure contribute towards his cash flows. Efficient management of cash flow is aimed at controlling the day-to-day financial affairs, which would enable the client to carry out activities that brings them satisfaction and enjoyment. In the previous example, we saw that the client was spending around 2,90,000 on lifestyle expenses. You can advise the client that he can curtail a few expenses which would increase the net surplus and thus help in achieving his goals. An efficient management of cash flow is aimed at choosing and following a course towards medium and long-term financial goals, such as buying a house, sending kids to college, or retiring comfortably. So, if you have a good amount of surplus, you can achieve these goals efficiently and without postponing any of the goals set. Building a financial safety net to prevent financial disasters caused by catastrophic illness or other personal tragedies is necessary. If you have a good amount of surplus, you can also build emergency fund and thus safeguard yourself from any kind of catastrophic illness or personal tragedies. After setting financial goals and gathering data, the next step in financial planning process is analyzing the information. We all know this is done to determine the steps that need to be taken to move the client from where he or she is at present to a level where he or she would like to be defined in the client's goals. At this stage, the plan begins to take shape. During the analysis of the information, the planner identifies the strengths and weaknesses in a client's plan. It is at this phase that the importance of good data gathering becomes obvious. Next is the emergency fund. Let us see how it is related with your cash flow. It is normally observed that individuals retain a sufficient amount of liquid assets at all times to handle emergencies, which avoids either borrowing money or liquidate investments during exigencies. However, since investments with the greatest liquidity tend to have the lowest earnings, it is important that the amount held to meet any emergency is not excessive. A good rule of thumb is that the client should hold a sum equivalent to 3 to 6 months of fixed and variable expenses in a liquid form for emergencies. This would exclude the expenses related to taxes, contribution to savings and investments. While creating an emergency fund, which is the base of any financial plan, we had seen that we need to consider mandatory family expenses. Now, these mandatory expenses are nothing but your fixed and variable expenses for which you should plan as to what are your emergency expenses and create that fund. For creating an emergency fund, expenses like taxation, contribution to mutual funds like SIPs or insurance premium cannot be considered, since these can be avoided in a situation where there is a contingency. Next is debt management. Let us see how cash flow is related with your debt management. Debt can be an important tool for clients in getting what they want and managing outflows, or it can be explained to be a drain on their resources. In general, debt is best used for large purchases, especially those that normally create equity, such as a mortgage for home ownership, where it would be difficult for clients to obtain the item for cash. Entering into debt requires payment of interest, which increases the cost of obtaining the item, periodic repayment of principal, which limits funds available for other consumption and savings. Therefore, consumer debt, that is your credit cards, automobile loans, etc., should be avoided when possible. This is particularly true for individuals who are unable to control spending when consumer debt is readily available. In addition, while mortgage interest is deductible for income tax purposes, interest on consumer debt is not. Hence, any financial benefit of carrying balances on credit cards or financing other purchases such as automobiles should be reduced. If you have a lot of debt, it means lot of liabilities. This means your outflows are blocked. In order to get free from debt, it is essential to plan your debt management so that your cash flow is set free, which paves the way for your financial goals. For example, let us say that a person is earning around rupees 1 lakh. Out of this, 50,000 goes towards fixed and variable expenses, 30,000 towards his EMI on a house or a vehicle. Now, he is left with only rupees 20,000. Out of this amount of 20,000, he might be paying insurance premiums and also might be saving towards SIPs and thus ends up paying towards some unexpected expenses. Thus, you can observe that if there is no concept of extraordinary savings, a person would reach nowhere and will continue to be at the point where he is. It is at this stage a financial planner should assist his client in managing his debt by either suggesting him to switch his existing liability or loan to a lower interest rate loan, or increase his loan EMI and pay off the loan as soon as possible in order to become cash free. This is the stage where you will understand the importance of cash flow while building the emergency fund and also managing the debt. In the industry, two types of statements are being used. Month after month, many individuals look at their bank and credit card statements and are surprised that they spend more than they thought they did. To avoid this problem, one simple method to manage their income and expenditure is to let them have their personal financial statement just like the ones used by corporate financial statements, which gives them an indication of their financial condition, which is helpful in the budget planning. There are two types of personal financial statements, namely personal cash flow statement and personal balance sheet. Let us try to explore this in detail. Personal cash flow statement. A personal cash flow statement measures your cash inflows and outflows in order to show the net flow during a specific period. Cash inflows generally include the following: salaries, interest from savings account, dividend from investment, capital gains from the sale of financial securities like stocks and bonds. These are a few examples of cash flow statements included in your net inflow column. Cash inflow can also include money received from the sale of assets like houses or cars. Essentially, your cash inflow consists of anything that brings in money. Cash outflows represents all expenses regardless of their size. Cash outflows include the following: rent or mortgage payments, utility bills, groceries, gas, entertainments like reading books, movie tickets, restaurant expenses, meals, etc. The purpose of determining your cash inflows and outflows is to find your net cash flow. Your net cash flow is simply the result of subtracting your outflow from your inflow. A positive net cash flow means you earn more than you spend during a specific period and that you have some money left over. On the other hand, a negative net cash flow means you spend more than you bought in. So now, you can work out a small exercise for yourself. Say, for a month, take a small diary which may cost you 10 rupees. Enter the date 1st March. Starting from 1st March, that particular page will reveal as to how much you are spending from morning till night. Total up that amount for that particular day. Now in the next page, enter the details of entire expenses for 2nd March. These expenses can be travelling expenses, snacks, mobile recharge, mobile bill payment, data card purchase, or any trivial expenses. Ensure to enter even the small expenses could be 50 paisa or 1 rupee. Repeat this for all the days till the end of the month, that is till 31st March. Now total up the expenses for all the days. Through this, you will come to know your spending nature, and accordingly you can analyze your cash flow, your outflow of money, and curtail few expenses which would help you to save more. This exercise can be done by anyone. Now let us see what is a personal balance sheet. A balance sheet is the second type of personal financial statement. A personal balance sheet provides an overall snapshot of your wealth during a specific period of time. It is a summary of your assets owned by you. Liability means what you owe. Your net worth means your assets minus your liabilities. Assets can be classified into three distinct categories. Liquid assets. These are things you own which are easily saleable or which can turn into cash without losing its value. These include checking accounts, money market accounts, savings account, and cash. Some people include certificate of deposits in this category. But the problem with certificate of deposits is that most of them leave early withdrawal fees. Thus, you lose a little value of investment made. Then comes your large assets or fixed assets. Large assets or fixed assets include items like houses, cars, boats, artwork, furniture, etc. While creating your personal balance sheet, ensure to take the market value of these items. If it is difficult to find the market value, use the recent sale price of similar items. Next is investment assets. Investments includes bonds, stocks, certificate of deposits, mutual funds, and real estates. You should record investments at their current market value as well. Let us see how cash flow and net worth go hand in hand. Please note that once your cash flow increases, you are left with a good amount in your kitty. What will you do with it? Start investing it. Once you start investing, your assets will grow, which in turn will help your net worth grow indirectly. Now, let us understand about liability, that is, what you owe or what you should pay. Liability includes current bills, payments still owed on some assets like cars, houses, credit card balances, and other loans. What is net worth? Net worth is the difference what you own and what you owe. Net worth is a measure of your wealth because it represents what you own after your payoff from everything you owe. If you end up with a negative figure, it means you have more liabilities than your assets. The two ways of increasing your net worth are 1. To increase your assets, or 2. Decrease your liabilities. You can increase your assets by increasing cash, which also forms a part of your assets. One note of caution is to make sure that you do not increase your liabilities along with your assets. For example, your assets will increase if you buy a house. But if you take a mortgage on that house, your liability will also increase. Increasing your net worth through an increase in your assets will be fruitful only if the increase in assets is greater than the increase in liability. The same logic works for decreasing your liabilities. A decrease in what you owe has to be greater than the relative reduction in your assets. To sum up now, personal financial statement gives you the tools to monitor your spending and increase your net worth. Please note that the assets and liabilities in a personal financial statement are not just two separate pieces of information, but they actually work together. Your net cash flow from the cash flow statement can actually help you in your quest to increase your net worth. If you have positive net cash flow during a given period, you can utilize that money either to acquire assets or to pay off your liabilities. Applying your net cash flow towards your net worth is a great way to increase assets without increasing or decreasing liabilities by increasing your assets. The bottom line is, if you currently have a negative cash flow or you want to increase your positive net cash flow, the only way is to assess your spending habits and adjust them accordingly. By using your personal financial statement, you become more aware of your spending habits and net worth. You will be well on your way to great financial security, and these tools will help your client to reach their goals successfully. Thank you.